Hello and welcome everyone. We're just going to give people a few more minutes to get in and then we'll get going. All right, welcome everyone to Money Talk Tuesday. My name is Eli Fenichel. I'm the marketing coordinator here at the Office of Economic Empowerment. Today's edition of Money Talk Tuesday is on investing, and we will be joined by Brad Wright of Launch Financial Planning and the Financial Planners Association. I'm going to go over a quick agenda, disclosures, housekeeping, and then we'll get right into the presentation. So a little bit about our office. We are a department within the Office of the Treasurer and the Receiver General of Massachusetts, and we are tasked with supporting, advocating, and facilitating policies that empower all Massachusetts residents. Our programs serve women, families, high school students, veterans, and seniors. And our priorities range from financial education, closing the race and gender wage gap, racial equity, to college affordability and promoting STEM education. As you already know, this is a Zoom webinar and will be recorded. And the recorded may be uploaded onto a public website for future use. And any information shared through the question functions will be anonymous. However, the chat record will be subject to public record laws and will not be anonymous. Once again, this is a webinar, not a meeting, so you will not be able to view other participants. You can use the chat feature at the bottom of your screen to communicate with the presenter, Brad, and myself. And you can also use the Q&A function throughout the webinar. And we really encourage you to ask questions at any point during the presentation or during the Q&A, and we'll try to get to as many as we can. And then lastly, please complete our post-event survey. This is a short 3-question survey, and it'll really help us a lot in continuing to improve this program. And then finally, we have an event next Tuesday at 12:30 for anyone who's interested. This will all be about saving for a child's future education, talking about 529 accounts. And if you are interested in registering for this event, we'll be posting about it on social media. And also, if you registered for this event, we will send a follow-up email with all the information for this. So without further ado, I'm going to pass it off to our host, Brad, for the presentation.
All right. Thank you very much. Thanks, Eli. Thanks
Of course.
to the Office of Economic Empowerment for having me. Investing 101, exciting stuff. Get everybody going on this. Before we start, I just want to give a brief disclaimer that, you know, we'll be talking about different companies and different ways to invest and things like that. And the opinions are for general information, not intended to provide specific advice or recommendations for any individual. We use reliable sources, but, you know, we may not be using complete information here today. And any specific companies mentioned are purely for example purposes. So with that, I will attempt to share my screen. And I don't have a lot of slides. I'm not going to inundate you with slides, but I do have a few that will just kind of emphasize what we're talking about. So again, my name is Brad Wright. I co-founded Launch Financial Planning in the middle of a pandemic last year, May 1st, with my partner, Jasmine. Turned out to be an okay business venture because it seems like a lot of people needed help, getting through this. We're a fee-only financial planning firm, which means we don't sell any products. We don't have any sales managers, anything like that. We are completely independent and work for the benefit of our clients. Whatever is the best for the client is what we do. I'm also the chair this year for the Financial Planning Association of Massachusetts. FPA is actually a national organization, but we have a Massachusetts chapter that's one of the largest with 800 to 900 members in it. We believe both Launch and FPA in financial education. So that's what brings me here with you today. I think there are a lot of people out there, a lot of advice given out there that tries to make things a little more complicated than perhaps it needs to be. So maybe that you think you need these people, or they feel needed maybe that way. My goal is to simplify things. My goal is to simplify this so you have a vested interest in the outcome, because it affects you and it affects you now and it affects your future. And it should be simple enough to understand so that you want to do it, so that you see successes and that you want to continue with it. So today, Investing 101, we'll get into the basics, the benefits of investing, how to get started, risk, compounding, diversification. You may not understand those terms yet, but hopefully you will. By the end of this, I'll run through a few slides. Again, not too many, just a handful to emphasize the points that we're talking about. And then we'll leave plenty of time for your questions. So to kick things off, we will start with a poll. We'll try and make this a little bit interactive, even though it's Zoom and we can't be together in person. So Eli will launch the first poll, and the first poll question is going to be, how do you feel about investing? A, scared. I've never done it before. B, okay, I have a retirement account or a brokerage account with some mutual funds or ETFs. Or C, great, I'm the next Warren Buffett. Look out, world. So go ahead. I'll give you 30 seconds or so to answer or give your best answer there, and we'll see where we're at, because it's always good to know who's watching, who's listening, and we can pivot in one direction or the other based on your answers. So scared, okay, or I'm awesome at this. What do you think? No one's the next Warren Buffett. All right. Okay, so 54% scared. I've never done it before. And then 46%, I have maybe a retirement account or a taxable account or something like that, maybe mutual funds or ETFs. All right, so I think that's good. Let's see if I can close this. This goes away. All right. So with that, we'll get going, I think. Hang on. There we go. All right. So your salary, if you're working, your salary is what pays your bills. Your salary pays the rent. Your salary puts clothes on your back. It keeps the lights on. It puts food on the table. It pays your day-to-day expenses. Investing, on the other hand, grows your wealth. So there's a difference. Yes, you need to make some of your salary available for investing, but once you're able to do that, investing is the single best way to change your financial position and create wealth. So yes, you may be scared, and yes, you may not have a lot of experience doing this. And we'll give you a little bit how to get started here, but just know that it is the single best way that can change your financial position and eventually lead you to retirement and financial independence. And really, it's just about beginning. Just begin. I say this all the time. It's just, no matter where you are in life, old, young, middle, you haven't done this, you've done this, just begin. Just begin from where you are and move forward. And first, I want to get into the why, right? So I've told you, yes, you need to do this. Why do you need to do this? And the real reason is compounding. Compounding is your money making money. Compounding is you invest money, you make interest on it, and then that interest starts making money. So then your money is making money, and it's compounding and growing forward and moving ahead. So let's look at this example. Eli, our other host today, and me. Eli saves $500 a month from age 25 to 35. So for 10 years. Then he stops. But he leaves the money invested. It's invested as he is putting it in, and it stays invested. It's earning 7% every year on the nose. Makes the math easy. And it grows till age 65. But again, he stops at age 35. Me, on the other hand, I save $500 a month, so same money per month, but I don't start till age 35. But I do it for 30 years, 35 to 65. Again, earning 7% a year, and my money grows till age 65. So poll question number 2 is, who will have more money at age 65? You only get 2 choices. Is it going to be Eli or is it going to be Brad? Now, remember, we're putting in $500 a month each. It's growing at the same rate. The difference is he starts at age 25, ends at 35. I start at 35, go to age 65. So he's putting in for 10 years. I'm putting in for 30 years. Who is going to have more money at age 65? I'll give you a few more seconds to put in your answer. Whenever you feel it's good, Eli, feel free to pop it up there. All right. Eli, 68. Brad, 32. All right. So the answer, Eli will end up with $702,000. Brad, only $609,000. So 68% of you were correct. It's usually the opposite, by the way. People usually guess me. So good going. Yes, Eli's going to have more. Why? Because he started earlier. And keep this in mind. He only put in $60,000 and got a return of $700,000. I put in triple that, $180,000. And not only, but only compared to Eli, get $609,000. So earlier is better because he had that extra 10 years of compounding, of that money making money. You know, Albert Einstein is famously quoted, although no one knows if he really said it, about compound interest. He says, "He who understands it earns it. He who doesn't pays it." So now you're understanding it. And now you can see Eli's going to have more. Brad's not going to have more. If he started earlier, he would have. And really, that's just the difference. Start. And this is not to say if you are 50 years old and you haven't started, you shouldn't start. Don't give up. Again, just begin. Start. Because as soon as you start, it will start compounding. So that's the why. And then how do you do it? What are you investing in? Well, there's stocks, there's bonds, there's mutual funds, there's ETFs, there's all sorts of things that you can invest in. So let's get into the basics of what they each are. A stock is you're participating in the profits of a company. So if you invest in a company and the company makes money, your stock increases. You're making money. If the company tanks, well, the stock doesn't do so well either. So you're buying into the profits, or essentially the losses of a company. Bonds, on the other hand, you're buying the debt of a company. So let's say on the stock side, you could buy an Apple, you could buy Ford, you could buy CVS, whatever you want. You're buying the profits of those companies. On the bond side, let's say Ford, they make cars, they make trucks, they make the F-150. Let's say they want to build another factory to build the trucks in, but they don't want to use their own money. So they're going to issue debt. They're going to issue bonds, and that's how you're participating in that. So they will essentially pay you interest for the life of the bond and then give you money back at the end of the bond. And, you want some of each. You want some on the stock side. You want some on the bond side. And we'll get into, that's diversification. We'll get into why coming up. So those are the basics. Now, do you want to just buy individual stocks or individual bonds? You can, but there's an easier way to do it, especially if you're just starting out. And that is mutual funds and ETFs. So mutual funds, you may have heard of. Basically, they are a basket of stocks or bonds. So instead of just buying an apple, you're maybe buying an apple and 100 other companies inside of one mutual fund. So you just buy the one mutual fund and you have pieces of all these companies, which works out. If Apple isn't doing well and you only own Apple, you're not doing well. But if you own Apple and pieces of 99 other companies and Apple's not doing well, maybe the other companies are, and your mutual fund could, still be up. It could still be growing. They're typically low cost. Again, they're diversified. Some have minimums for investing in them, but many do not. It shouldn't be too hard to find one that doesn't. I mean, a couple $100 into a mutual fund and it diversifies you. You can do that. And they're flexible, meaning you can buy one, you can buy many, you can sell out of them and take whatever it's worth of your money at that point out. Usually, you sell it and the next day you can get whatever the proceeds are back in cash. The thing about mutual funds is, stocks and bonds trade throughout the day. You can buy it, anytime the market's open, or sell it anytime the market's open. Mutual funds price at the end of the day. It's called net asset value. So they set the price at the end of the day, and everyone who's buying or selling that particular mutual fund that day will get that price. So you're not trading mutual funds throughout the day. You're just, you're buying into it or selling out of it at the end of the day, set on that price. So that's a mutual fund. An ETF is similar to a mutual fund. So an ETF is also a basket of goods, underlying stocks or bonds. But you can trade them during the day. So they trade like stocks, but they look like mutual funds. They tend to be less expensive. They tend to be more tax efficient, and and that's because they're cheaper because they're passive. Most of them are passively managed. So passively versus active. Passive is, if you bought like a large cap mutual fund or an ETF that tracks, let's just say the S&P 500, because that's an index that a lot of people know and talk about. They would just match up to the companies that are tracked by the S&P 500. They would design their ETF to have those same companies in it, and just with equal percentages, and let it go, and not really change too much unless the index changed. Versus active managed, they may start off to mirror an index, but then they could be more strategic. They would have a manager that said, well, yeah, Apple's in this index, but I don't think they're going to do well, so I'm going to underweight it and I'm going to put more money into something else instead. So active is usually more expensive than passive. Theoretically, it's more expensive, but they perform a little better to compensate for the extra fee you're paying. Does that always work? No, not always. Sometimes it does. I believe in both. We use both. We use passive and we use active, depending on the strategy that we're trying to achieve. So that's how you would do it. So the compounding is the why to invest, because your money is going to keep making money. This is the what to invest in. So there's stocks and bonds, individual stocks and bonds, or buy them as baskets, as groups, as mutual funds or ETFs, which will simplify it for you, because it's a lot easier to look at how your mutual fund's doing than to have to track a whole bunch of individual stocks to see how your portfolio is doing. So diversification is also a very important aspect of investing. The definition is a process of allocating capital in a way that reduces the exposure to any one particular asset or risk. Basically, you're trying to prevent the tide from raising or lowering all boats at the same time. For instance, last March, COVID hit and the market collapsed. Well, the stock market collapsed. It went right down. But you know what? At the same time, the bond market was actually increasing. So if you had all stocks, your boat ended up on the shore, like these two boats in the front. If you had stocks and bonds, well, maybe your boat is still floating there in the background because the bonds, kept you from hitting ground. And then, you may have rebounded quicker as well. So that's the basics of diversification. Even Apple started out as a computer company, but they're not just a computer company. They have iPhones, they have iPads, iPods, iWatches, the App Store. They're a diversified company now. So if they have a bad computer season, probably something else is keeping them afloat, is doing better for them. So you don't just want to put it all in one place. You want to be able to diversify it so all boats are not going up or down at the same time. And this is a little more of a maybe convoluted chart. But if you just look at the white graph on the left side of that says small, as in small companies, mid-cap companies, large cap companies. So small cap companies are not small to you or me, but 0 to about $2 billion companies. Mid caps are about 2 to 10 billion, and large are, anything over that. And then along the top, you'll see value, blend, and growth. So value are like energy companies or financials like banks or a utility company, something like that. Whereas growth is more the tech, the healthcare, the communications companies, everything that's in the news, everything you hear about, the Amazons, the Facebooks, the Apples, the Microsofts, those are all the growth companies. So the values tend to be more established, and they grow at more of a slow and steady pace, and they may pay you a dividend. So they may be paying you essentially interest quarterly or monthly while you own the stock. The growth companies should be appreciating more rapidly, but they're not going to pay you in addition to that. So you bought into the growth because you think an Apple or an Amazon or a Facebook or whatever it is that you're interested in is going to grow, and you want to participate in that. And over the last year, all those stay-at-home companies, they did just that. Everyone was forced to use them. They made money, and their stock went up. So the blue on the right, the blue boxes on the right, just show you this particular ETF. Actually, it's a large cap ETF, and it just shows you, it's predominantly in the large cap space, but spread out between the value, the blend, and the growth. But if you only had, so even though this is an ETF, it's a basket of large cap. So yes, you're more diversified than owning one large cap stock, but you're not probably as diversified as you should be because it's just one basket of eggs. And if this basket of eggs goes down, then you're going down with it. But if you had some mid cap and you had some small cap also spread across the value, the blend, and the growth, and even within that, domestic US companies, there are international companies you can invest into. And then there's the bond side where, again, you're investing, on the debt side as well. So if you have a little bit of everything, then instead of, when volatility is spiking up and down, peak to trough is very steep. If you're more diversified, yeah, it's going up and down, but it's more of, peaks and troughs are less so. So, depending on your risk tolerance, that, maybe helps you sleep better at night, maybe helps you feel like you're not, in the front seat of a roller coaster every time something comes on the news about the market. And risk is really a good place to start. So, we've talked about the why you want to invest. We've talked about the what to invest in, but how do you choose? And it's really based on your risk tolerance. Any financial planner that you speak with is going to properly assess your risk first. But there are, you can find different questionnaires and things like that online too, if you're doing it on your own. And you want to properly assess your risk because ideally you want to invest for the long term versus being a day trader. Day trading is what's all in the news. You hear, oh my God, I made all this money today, and then I lost it all tomorrow. That's not what you want to be doing. You want the slow and steady process, not the get rich quick scheme. You want to have a plan. You want to assess what your risk is and invest for the long term based on your risk. And the number one reason for that is because you want to stay invested even during the bad times. It's easy to stay invested during the good times. It's not as easy to stay invested in the bad times when you see everything going down, but you should. You know, when COVID hit last March, I do a lot of stuff here in town for Channel 5, a lot of financial sort of correspondence work. And I feel like that was my second job. When COVID hit, I was there every day. And one day I used an example of, you know, over the last 20 years that the S&P 500 index, you know, it grew over the past 20 years. And if you missed even the top 5 days in the market, you severely underperformed the S&P 500. And how does that happen? It happens because you get scared. You know, COVID hits or the 2008 crisis hits and the market goes down, and it goes down fast. And, you know, maybe it goes down a little bit and you jump out. So maybe you miss a little bit more of the downturn, which is okay. But how do you know when to get back in? And have you gotten back in? And, or are you still, you know, a year since COVID has hit and the market went down, still sitting in cash, not knowing when to jump back in? And that's how you lose out. You're never going to hit the bottom exactly. You're never going to hit the top. You just need to assess your risk and get in there. And it's funny because on my way home from that day at Channel 5, I got a phone call from somebody I knew that said, "Hey, that was great advice. I totally just cashed out today." Wait, you didn't listen to my advice then. So, and then I spent, you know, the next 6 months trying to help this person. It's a friend. It's not a client. It's a friend, you know, slowly get back in over time. So that's the main thing, is you want to be able to deal with the bad times as well as the good times and be, you know, a long-term investor versus a trader. And by the way, if you're invested in a company 401k, you know, any kind of 403b, any kind of a company retirement plan, if you kept investing March, April, May of last year as the market was going down, you were getting deals. You were getting every paycheck. You put money into that 401k account, and the shares are getting cheaper and cheaper, so that when it finally turned around, you actually had more shares and you made more money on the way back up. So that's why you want to be diversified. You want to just control the chaos a little bit more. So, and I touched on it briefly. How would you, you know, what kind of accounts would you open? What would you do? So poll question number 3, we'll get to that. Let's pop that up. It's sort of a, where do you invest, right? So do you currently contribute to a retirement account? A, yeah, 401k, an IRA, or some traditional retirement account, maybe through work or outside of work. Yes, a Roth 401k or a Roth IRA account. Or C, no. So there are 2 yeses, but different type of accounts, either traditional or a Roth, or you don't. You haven't started doing that yet. And there's no wrong answer. Let's see what we have. So yes, traditional wins out at 50%. So some sort of maybe a retirement account at work, a 401k, 403b, a 457 plan, or maybe on your own through an IRA. Or next up is a Roth, or nothing. Okay, so let's touch briefly on the differences between those. So if you have a traditional retirement plan, whether it's, let's just say the 401k, you have a traditional 401k plan at work. Your money goes directly from your paycheck into the account. It goes pre-tax, it grows tax deferred, and you end up, when you retire and start taking the money out to cover your expenses, that's when you pay the tax as you withdraw the money. A Roth 401k works a little bit differently. So you pay that tax upfront now. You pay the tax now, but then it grows tax-free and it comes out tax-free. So let's say that genius Eli, who made more money than me, actually took that $60,000 or $500 a month for those 10 years and put it into a Roth. So he had paid the tax on the $500 and he put it into a Roth. And then by the time he turned 65, it had grown to over $700,000. That's tax-free money to Eli, which makes him way smarter than just starting earlier. Because he had such a long runway for that money to grow. He was really able to take advantage of the Roth. Now that's different for everybody. Obviously the younger you are, the more runway you have for that to grow and be tax deferred. Also, the lower your income, the less tax you're paying now on that money and then putting it in and letting it grow. You know, the traditional IRA, you're deferring the tax. So lots of people try to shelter that tax now because maybe their salary has increased, they're making a good amount of money and they want to pay less taxes now. That's fine. You won't pay the tax now, but you will on the other end when you're taking it out. So that's the difference. Again, just begin. You know, you won't miss it if it's going from your paycheck. It doesn't touch your hands. It's going directly into the retirement account. You know, it's like Monopoly. Go. You know, don't pass go. Don't collect $200. If you don't touch it, you're paying yourself first. You may have heard that term before. Pay yourself first. You won't miss the money, and it's going to really benefit you in the long run. And the other thing, so you could set up, right? And say, hey, 10%, I'm going to put in from my paycheck to my 401k. And you can set it up usually to increase, you know, maybe 1% a year. You're giving yourself a raise at that point too. And don't borrow. Don't borrow from your retirement account. Yes, you're forced to pay yourself back with interest, but you're taking the compounding away. So while it's out of the market, it's not making money. It's not growing that $60,000 into $700,000, you know, 30 years down the road, because you've used it for something else and it's not working to your benefit. So really that's, you know, those are the basics of what I wanted to at least cover in the comments. And then I wanted to leave a lot of room for your questions. So I know Eli probably has some to start with. And I see some questions coming in the chat. I think Eli will relay those to me as well. But you know, those are the basics. What is it? What is investing 101? How to do it, why to do it, and where to do it. And then we can get into, I'll stop sharing my screen and we can get into whatever questions you may have.
That was really great, Brad. Thank you. And I'm really loving this hypothetical version of Eli who's making $700,000.
Eli, this Eli is a genius, I tell you.
I know. He sounds great. So we actually have quite a lot of questions coming through. And so we do have some of our own, but I'm just going to start with these because I want to make sure we get to them all.
Okay.
All right. So let me start off. So someone, when you were talking about compound interest, someone asked, how does compound work? Because things crash all the time and you can lose all your money. I think this is talking about that 7% return in your hypothetical example.
Yep. So a 7% average return over 20 years doesn't mean you're going to get 7% every year, right? You could get 10% one year, or you could get 2%, or you could get a -%. So the short term is going to fluctuate a lot more. The long term, you stand a chance at making that 7%. So the longer time horizon you have, the more you're able to hit that bogey, whatever it is that you're trying to get. So I read something recently that said, if you invest money today, you have a 50-50 chance of it making money by tomorrow. You have a 68% chance of it making money a year from now. You have an 80-something%, between 80, close to 90% chance of it making money 10 years from now. And above that, it goes up. So the longer time horizon you have, again, long-term investing, not day trading, the longer you give this money a chance to compound.
Yeah, I think I think I have to keep that in mind when you see the market go down. It's scary and tempting to take out your money.
It is.
Okay, so we actually got a couple questions in the chat. One was, can mutual funds and ETFs be bought for short and long term, or just trading during the day?
Nope. The goal is to buy them for long term. Mutual funds you can't trade during the day. They are priced at the end of the day, and you get whatever that price is if you're buying or selling. You can move in and out of them. If you bought one and you decided it was a bad idea. So when I say long-term investing, I don't mean keep the ones that aren't working for you. I mean, stay in the market. But if you have a mutual, if you're using mutual funds or ETFs to be properly diversified, you can probably do it with 10 to 15 mutual funds or ETFs in a portfolio. But if one or two of those aren't working, change them, get rid of them, and buy one that is working. So you can get in and out of them. They're not really made for trading. ETFs you can trade during the day. You can get in and out of them if you're going to sit there and watch the market go up and down all day. You can do that. But again, we're talking about long-term investing and not really trading. So you want to assess your risk and then diversify based on that, so that you're able to stick with it.
So this is actually kind of related to one of the questions I had wanted to ask.
Okay.
I hear this all the time from people I know in my life. There are just a lot of different investment options that you just talked about. There's ETFs, mutual funds, international funds, large stock blends. And then even within these categories, there are like a lot of options. And so it can be pretty overwhelming. So I was wondering what your process is for deciding, all right, which of these categories are right for me, and even within these, like which match my needs. Like how do you go about doing that?
Right. So what I do is probably different than what you're going to do as an individual. What I do as a company is, we have Morningstar and different research capabilities that, and we do this full time every day. So 40 hours a week, we're watching the news, we're watching the markets. It's our job. We're supposed to do it. You're not supposed to do it. So, we do the research and we screen funds and we screen ETFs and we talk to the managers who run these funds. And we decide overall the sectors, whether it's large cap growth, small cap value, whatever it is, where we want to be. And then we actually screen for the best funds within. Now, are you going to do all that? Probably not. You can, if you have a 401k, you probably have 10 choices and you have the performance there and you're able to look at it and pick the best ones that are right for you. But the other side of that is if you're not comfortable doing that, or you don't want to do that, or you don't want to spend the time doing that, you can buy a balanced fund. Or in your retirement account, you could buy a target date fund. So let's say you're in a 401k and you have all these different individual choices, but you also have a series of target date funds. They'll say target date 2030, 2035, 2040. You pick the date closest to when you think you're going to retire. So you could pick target date 2040. And it's one fund, it's one mutual fund, but it's diversified with stocks and bonds within that fund. And right now it's probably more stock heavy because you're a little bit further away from 2040. You're almost 20 years away. But it will automatically adjust. It's called the glide path. It will automatically adjust and get more conservative, so more on the fixed income side, as you get closer to retirement. So it's kind of a set it and forget it. You could do that. Now, is that the best option? Are you going to get the best return that way? No. But are you going to get a return? Yeah, you are. And it's way better than doing nothing. And you're going to get, you should get a decent return. So it's not a bad place to start. If as you're just, we do that for clients actually who are just starting investing in the beginning. We'll put you in a balanced fund or a target date fund until it builds up, and then we'll diversify you outside of that into the individual mutual funds or ETFs.
Got it. That's great. So we actually just got a question from Facebook. This is, a little different kind of investing. Someone asked, can you discuss multifamily property investment and like do's and don'ts that you might know of?
Multi-generational families, like passing it down
Um,
or renting
multi
properties?
multifamily property. I think that might mean like,
Oh, that you're renting out?
yeah,
Oh, as an investment?
yeah,
Well, generally I can say, yeah, people, people do decide to do that. We have had people that have said, you know what, I want to take my investment money out because I'm going to start buying property, and either live in it or not live in it and rent it, or live in it and rent it. And there are different tax implications. So I'm not going to get into that, depending
yeah.
on if you're living there and, what you're renting and for how long. So I'm not going to touch on the taxes. But yeah, it can be an investment. It's normally an income stream to do it that way. So, if you're investing in the market, you're investing for long-term growth, not necessarily income right now. If you're investing in property, you're going to be getting income, right? Because you're paying rent, or somebody's paying rent to you. So you're getting an income stream, which is not bad, but that's going to change your tax implications too, because you're going to be paying tax every year, that people are paying you the rent. So, 20 years ago, I would have said, well, I don't know about that because, homes appreciate like 1.5%, but, recently they've gone up crazy amounts. So if you had some rental properties, you made some capital appreciation as well as the income. Is that going to continue? I don't know. Are we in a bubble? I can't answer that either. But it's an income stream option if you decide to go that road.
Okay, so now back to mutual funds and ETF. A couple people have asked, where can you find these mutual funds or ETFs?
Well, you need to open an account, and you can open an account anywhere you want, right? So if you have a retirement account, you're opening whatever your employer says is your company plan, and they're going to give you a set amount of choices, most likely mutual funds in there, and you'll have to choose within. If you're opening your own outside account, and I'm not recommending any of the above, but you could go to Vanguard, you could go to Fidelity, you could go to Schwab, you could go to E-Trade, you could go to, any place you want and open an account. And once you do that, you'll be able to research funds, stocks, ETFs, all of those on that platform. You should be able to see the performance of all of them that you're able to buy on their platform on there, and screen them that way. Typically so if you went to like a Fidelity or something and you open an account and you went to mutual fund research, there'd be drop downs and you'd say, I want to look for large cap value funds, and you check that and they're going to just list all those for you.
Right. Okay. Also, this is kind of related. Someone asked, this is great info. Can you give full name versus acronym of resources? Use language that is less technical. I just wanted to give a quick notice that all of the definitions, terms we've talked about today, we're going to be sending out in the follow-up email, and we'll have them all defined, full names. And someone also asked about the recording, and we'll be sending out the recording to this as well. We're going to keep getting through these questions. I'm going to be honest, we're not going to be able to get through all of these. But again, in that follow-up email, if you're registered, we will be sending links both to reaching out to us, but also to Brad's organization and other organizations if you want to talk to a certified financial planner.
Yeah, and actually, so I'll just add to that real quickly, and I apologize if I'm being too technical at all. I realize it's a lot of information in a short amount of time.
Yeah.
So I realize it may seem like too much at times, but I want to give two other websites that we will also send out to you. So if you're searching for someone to help you, the CFP board, Certified Financial Planner, has a website. It's called letsmakeaplan.org. You can go on there and search for a financial planner to help you in your area. The same for the Financial Planning Association. Theirs is plannersearch.org. And you can click on those and you can, put your filters on there and search for someone to help you if that's what you're searching for too.
Yeah, and I'm actually going to send those in the chat right now. So, okay, let's go to the next question. Are mutual funds just stocks or just bonds, or do they include both? We've covered this a little, but if you want to.
Yeah, the balance funds include, or the target dates include both. You would typically want, you would, when you're diversifying yourself, if you're buying a balance fund or a target date fund, you'll have everything within. If you're not, there are specific ones on the stock side, specific ones on the bond side.
What happens when you have a work retirement account and you switch jobs? What happens to the money you had in the retirement account at the previous job? That's a great question.
You have 4 options. You could have the option to leave it where it is. But that involves, if you're job hopping, you could end up with 4 or 5 retirement accounts that you're trying to monitor, and typically those get forgotten about. You could probably roll it into your new job, assuming that they accept it, which most do. So if I leave my job and go to another company, I can probably roll my existing 401k into my new 401k. I would also have the option to roll it into an IRA, so not affiliated with any company. You can open up an individual retirement account and roll it into that, or you can cash it out. But I wouldn't suggest cashing it out because you're going to be taxed on it, especially if it's a traditional retirement account. And if you're under age 59 and a half, you're also going to be penalized for taking out the retirement money early. So rolling it over, and again, which is the best? So you look at the costs between the 2 401k plans or an IRA, look at the cost and look at the choices. Typically an IRA will give you a lot more choices, but you may want to keep it into your 401k. So those are the primary options you have.
And is there generally a time limit on how long you have to roll over those accounts?
Not a direct rollover. So if you're doing a direct rollover, which means you're doing it from plan to plan, then you can do it whenever you want. If you're doing a rollover and they're sending you the check, first of all, don't have it made out to you. You're going to have it made out to wherever it's going next for the benefit of you.
Right.
But if you touch the check, if you receive the check, you have 60 days to get it into the new account. Otherwise, it counts as a distribution.
Okay. Someone asked, can you set up a Roth account for your kids?
You can, as long as they have income.
Okay.
So as long as, if you have them on your company payroll or something like that, and they're making money, then you can.
Okay. Next question. What is the best way to start one's retirement plan?
Just begin. I mean, if you have the option to do it at your company, do it, especially if your company matches, by the way. So lots of companies will match 3 or 4 or 5% of what you put in, but you have to put the money in first. You have to start. So if that's the case and you're not putting in the 3, 4, or 5%, they're not putting in what they promised to give you. And that's free money. That is free money from the company. So you should at least be putting that in so you get the match. If you don't have that opportunity through work, but you have income, then you're able to open up an IRA anywhere you want, whether a traditional or a Roth, and start investing that way. Great.
So this question is actually back to that compound example. Someone said $500 per month is a lot of money to invest for many people. With cost of living so high and wages stagnant, where do you suggest people on the lower end of the income scale start?
Right. And honestly, those numbers were just so I could do easy math. And
yeah.
This is why I chose those numbers.
Makes the calculations easier.
Yes. I understand that could be a lot of money. So look at it this way. Lots of people talk about having a budget. I do not talk about having a budget, because your eyes are going to gloss over and you're going to hate it, because you're going to say, oh my God, Brad's telling me I can't spend any money now and I have to save it until I'm retired, when maybe I'm not healthy enough to use it. Right? Everyone hates that. So let's look at it like it's cash flow, just like a company, right? Certain amount of money comes in, a certain amount of money goes out, and it has to be equal. Otherwise, you go into debt, and you don't want that. So whatever is coming in, your income, your cash flow, you make the choice. You have a choice to, I want this, I need this, I don't want this, maybe I don't need this. You make the choice so it nets out at zero. And that's where your initial seed money, your investment money comes from. It comes from your cash flow. However much you can peel off of that cash flow and put it into an account and let it begin compounding for you, that's the way to start. You know, most mutual funds or ETFs don't have a minimum. So you can start by putting in whatever you can put in.
Great. Okay, so we actually got two questions that are pretty similar. What are the best resources to use to begin investing in stocks, bonds, mutual funds? Similar question was, any sites you can suggest for beginners? One thought, would you recommend Robinhood? One talked about TD Ameritrade. Do you have any thoughts on that? Like these Robinhood or other like apps for investing versus like something like TD Ameritrade or Vanguard?
Sure. So I'll handle the research part first. So
Yeah.
Where do you go to find out about these things? Wherever you open your account will have some sort of a research platform on there, because they have to offer you the prospectus, which is all the behind the scenes details on whatever you're buying. So if you open up an account at Vanguard and you're going to buy, you want to look at large cap, growth funds, you filter that on the website, and then you should be able to click on each of them and read a little bit about them. So you can get research that way. You can also, Morningstar, there is a free version online. It doesn't give you a whole lot, but there is a free version that you can go on and screen and rank them according to how they've done recently, or 3 years or 5 years or whatever you want to look at, and then start looking at it that way. So that's what I would say as far as, your initial research. Now, as far as the Robinhoods and things like that, I sort of break it down into three categories. There are the do-it-yourselfers, right? You're going to either open an account at a Vanguard or a Fidelity or a TD, or on an app, like a Robinhood type of a thing. And then there are the robo-advisors, the Betterments, the Wealthfronts, where they assess your risk, you put your money into their portfolios, and it's invested and rebalanced through their algorithm. You don't have a lot of interaction with anybody, but your money is getting invested as per your risk tolerance, which is good. And then beyond that is, human advice, where you're dealing with a financial planner, financial advisor, and they're helping you through this whole entire process. Now, people usually graduate through all three. People usually start with, an app or a robo-advisor or something like that. And then life happens. There's a life event somewhere where you need, some sort of interaction, some empathy, some human guidance, that sort of thing. And that's where the financial planners come into play. So there's nothing wrong with any of them. It's just how much hands-on advice you need versus, are you willing to do it on your own? There are passive and active funds. I can get into that a little bit. Passive, you're just tracking the index. The active, they may be more strategic. So if the robo advisors will tend to use the passive ones, right? They're gonna diversify you into those and just follow the indexes for you. But if you wanted to be more strategic, maybe you need somebody to help guide that as well. Did I cover both?
Yeah, that sounds like a good little explanation of both those options. So someone asked, we actually talked about this when we were promoting the event, because a lot of people ask about this, but someone asked, what are your thoughts on cryptocurrency? Is that more of a quick day trade strategy? I'm sure you were expecting this. Or is there a potential for long-term growth there? And I also hear this a lot, like thoughts on cryptocurrency. You see, as you were saying, all the things in the headlines are about like huge quick surges in companies like GameStop. And it can be really enticing for people when this is what all the news is talking about.
Yep.
So what are your thoughts on that?
And your friends as well, right? And which I'll start by saying, don't listen to your friends, because your friends are saying, I made a ton of money on this. They're not telling you, I lost my shirt on these 4 other ones. You know,
Right.
they're only telling you, they're only giving you the good parts. You know,
Yeah.
ask them to show you their entire statement and see where they're at. But yeah, so cryptocurrency, I kind of look at it like this, right? So it's new. We're still all kind of figuring it out. I would say if you're interested in investing in that, cover your basics first. You know, when you get your salary, you're putting food on the table, clothes on your back, and you're paying the rent. And you do that first before you go out on the town and spend the rest of your paycheck. So it's a similar situation. So cover your basics first with a risk appropriate, diversified portfolio, mutual funds, ETFs, whatever it is you want to buy. And once that is up and running and you see it steady, you're putting money into it. If you wanted to, you know, take like 2 to 5% for a speculative investment, which would be cryptocurrency at this point, I don't really have a problem with that. But keep the percentage small and know that you could lose it.
Yeah.
Right? It has to be money that you could be okay losing. It's still so uncertain that us as advisors can't buy it for clients yet. You know, it's one of those things you have to do on your own. We can't, you know, we custody all our accounts at TD Ameritrade, but that there's no option for us to buy cryptocurrency on that platform for clients. So you're kind of on your own. We can talk to you about it, but you know, the investment and monitoring is kind of on you. So I'm not opposed to it. I mean, I think there's probably something to it. The SEC, the Securities Exchange Commission, is still trying to figure it out. There eventually are going to be ETFs. You'll be able to invest in it through ETFs, but they've put off the approval until July so they can study it more. But it, you know, it's going to be a sector.
So it seems like for now, go at your own risk.
Yep. Same with options, by the way. You know, there's a lot of news about people buying and selling options. That is, that's leverage. You're buying and selling with leverage, and yeah, you could gain big, but you could lose big too. And it could all happen very quickly. I don't really see a need for options.
Yeah. So this is a different topic, but I think it's a great question. If you are in a lot of debt, how much should we put into retirement? And I think that's an interesting thing to think about, because some people are in debt, and you hear sometimes people saying you should pay off all your debt before doing this, or you should push off paying down your debt. So what's your take on that?
That's a very specific question, and my answer would probably be different for each person who asked it to me.
Right.
But there's a balance, right? And what is the debt? Is it credit card debt? You should work on paying off the credit card debt. Is it a mortgage or an auto loan or a student loan? Well, okay, that's okay. You know, as long as you're paying it off, going along the way, at least paying the minimum, and if you have money, you know, left over to invest after that, then you know, that's a happy medium. That's a good balance. So it kind of depends on what the debt is and how much it is. But, you know, you do want to, if you're still incurring the debt, you need to handle that first, right? You need to go back and look at your cash flow. Again, what comes in has to equal what goes out, or that debt's going to keep growing and you're never going to get it under control. So you need to get that under control. And then depending on what kind of debt is, strike some sort of a balance so that you're paying it off, but also building for your future.
Great. Okay, so we have like 2 minutes left. I'm going to try and get like 1 or 2 more questions out. Sure. There are a lot left. So really, anyone whose question didn't get answered, please reach out to us after, and we'll send you links to organizations like Brad's that you can reach out to. Okay, if your employer has a simple IRA that is connected to a target date fund, would you add a second IRA that is not a target date to get the best return?
You should be able to invest in something other than a target date in the simple IRA, I would think. There should be other choices. I mean, if it's IRA, it's probably open to a lot more. Yeah. So you shouldn't need to open a new account for it. What I would say, though, is typically you wouldn't do target date and diversify on your own. Usually it's one or the other. because you're probably over concentrating in certain areas if you're doing both. So it's either the sort of the set it and forget it model, or, hey, I want to do this and diversify it on my own.
Yep, that makes sense. All right, last question. Let me go back to the Q&A. What's the maximum you can have in each if you have a 401k and a Roth?
So it's the 19,500. That's the limit. If you're under 50,
Yeah.
for this year, that's it together. So if you have a traditional 401k and a traditional Roth, you can split it up, but it's not 19.5 in each. It's aggregate together.
Right. Okay. All right. It's 1 o'clock. Someone actually just popped in. Are you doing this webinar again later? There's a lot of, there's a lot of interest in this. So we'll definitely have to think about it. But again, we will be sending this recording to everyone who registered after. If you have any more questions, again, we'll be sending links to Brad's organization, other financial planner organizations in the state. Thank you everyone so much for coming. Thank you, Brad, for this amazing presentation. Final reminder, we do have one more Money Talk Tuesday in June. Then we're going to be taking a little break for the summer. If anyone has any thoughts on what future Money Talk Tuesday topics we could cover, like doing another version of this webinar again, please reach out to us. And don't forget to fill out that quick survey you'll get right as you leave this. Is there anything else you wanted to add, Brad, before we take off?
No, just thanks to you, Eli, and your organization for having me. And thanks for everybody being on here and having a lot of questions. That's what makes it, I think, more interactive and a better outcome for everybody. So thank you.
Yeah, this was super fun. Thank you, everyone. And I hope you all have a great day.